Hi there, Shingirai here again with another update on portfolio performance over the past week. On a 1 week basis, we've seen a relatively risk-off sentiment, which would see portfolio number 5 underperforming all the rest of the portfolios, returning minus 2.09%, with the more defensive portfolio number 1 returning just 75 basis points in the negative as well. We did see a flight to safety, and that will be evidenced by the performance of government bonds and also UK gilts, with all those three positions being our top performers on the week, up more than 17 basis points on the 1 week basis. In terms of detractors from performance, we continue to see that deterioration in macroeconomic data coming out of China, acting as a headwind for Chinese equities, and that would see all three positions across Columbia Threadneedle down to HSBC MSCI China, indicating a downwards move of 4.25%. Alongside some of the weakness we did see, of course, with Beijing moving, or the People's Bank of China rather, moving to adjust the loan prime rate down 10 basis points, ultimately not being enough. Despite, of course, the backdrop of fixed asset investments and industrial production also coming down, with the expectation towards the end of the week where we'll see also manufacturing PMI expected to come in at contractionary territory as the market really begins to seek out some sort of indication coming from Beijing, where they'll be able to give the market confidence that we'll see a bit more fiscal stimulus, which really prompted the swift growth of the Chinese economy, but also with Beijing forced with to handle a balancing act where they're trying to manage inflationary pressure in the shorter term with also the objective of long-term growth. And currently Beijing seems to be happy with that 5% GDP growth expectation for the year 2023. In terms of quarter-to-date movement, again, we do see that there have been some headwinds in terms of performance, with returns ranging from CBAM 5 V2 returning 33 basis points down to CBAM 1 V2 returning minus 1.78% in what has ultimately been more of a sort of risk on quarter-to-date period. And also we've seen some market participants who had feared missing out on that large sort of tech or mega tech rally that you've seen from US markets beginning to enter the markets over the past month or so, and that would see Fidelity US equity up 6.6%, alongside the unhedged position in Fidelity US equity up 4.41%. In a month we've also seen sterling strengthening about 3% versus dollar as well, alongside some strong performance from our Japanese equity positions, which we've been highlighting over the course of the year, with Fidelity Index Japan up just shy of 5%. As I spoke on earlier, we continue to see these headwinds for our Chinese equity positions across Bailey Gifford, Columbia Threadneedle, HSBC MSCI China, all down more than 11%. Coming into the quarter, again, as investors look for some solid sort of concrete proof that there will be some fiscal stimulus coming out of Beijing, and that'll be something that would be expected as well, alongside some support from the property market, which has been in quite a couple of woes over the past couple of 24-month period as well. But interestingly, in terms of on the macro front, we have seen sterling sort of stable above 1.25 against the 1.27 rather versus the dollar, and we continue to see some robust data coming out of the US economy at the beginning of the week in terms of building permits, new homes, consumer confidence, and just recently trade balance, all improving. And then later on in the week we'll be looking for some GDP data coming out of the US as well, and some jobless data coming out of the US, with expectation for first quarter growth of GDP coming in at 1.4%. And then we'll get that UK GDP data on Friday as well. That would also be helping us to map a way forward or a path forward for central banks across developed markets as well.